So what we try to do in this chapter, monetary sector, we look at, first of all, money supply. We look at money demand. And therefore, we look at interest rates determination. And also, we will look at why is AD curve downward sloping. So we look at the effect of interest rates and how it affects your demand for goods and services. So these are the four things we look at within this chapter. In this second discussion, we look at your monetary policy. But right now, today, what we look at is money supply, money demand, how we determine interest rates, and then why is yield curve downward sloping. In fact, within this, I'm going to write the interest rates effect. Okay. When we look at money supply, before we talk about money supply, money is sort of divided into broadly two things: your narrow money and your broad money. Narrow money is all the money that is basically regarded as a means of exchange. So for us, means of exchange is to buy goods and services. So for us, this may include your notes and coins, so your currency, which is your notes and coins and all, and may also include sometimes your deposits, what we call those deposits which do not give you any interest. So we call that current account. Sometimes we call it your cash deposits and all. So that is part of your what we call narrow money. Or your broad money, we say that it's all the narrow money, but sometimes also things which are used as a store of value. So you are gaining some wealth from them as well. So this would be basically all your narrow money, which you can see in deposit, but also may include your savings deposits, which may be less liquid, which means not easily converted, or sometimes they may even include your bonds and securities. Okay, so these are the ones that you may need to liquidate to use them, but they did give you some return or interest, and that's why they have another feature to it, which is store of value. So when you look at money, money is basically narrow money and broad money combined together. So let's now talk about what are the sources of money supply. This comes a lot in MCQ. Sources of money supply. How does the government increase or decrease money supply through its central bank? So the first thing we look at is, number one, is your bank lending. You know what we call, sometimes also called credit creation. Okay, when banks are lending, we say this, that this bank lending can create more money because it creates more deposit, and since deposits are regarded as money, so we will have more money supply. How do we say that? Well, so how does this work? So let's say we'll make a bank's account. So this is a bank number one. It gets a deposit of $100. So on this side, I'm going to write all the assets of the bank, and on this side, I'm going to write all the liabilities of the bank. Okay, if a bank receives a deposit, we will regard that as a liability, because they have to repay the depositor whenever the depositor asks for money. So what do they do with this when they get a deposit of $100? They are in the business of getting deposits and then lending them to the people who are asking for money, right? So for them, the asset is the loan. But the problem is they can't loan out everything. They have to keep some money as what we call reserves. And that reserves is basically found through what we call reserve ratio, also called cash ratio, also called liquidity ratio. So sometimes the government through its central bank says this, that you are not supposed to lend everything that you get as deposit. Please keep some money as reserve, because sometimes somebody can ask you for that money and you may need to have that at that point. So let's say 90 is kept by the bank, because 10% of 100 is 90. So that would be 90 would be kept as your reserve, but 10 would be 10 would be your reserve, but 90 would be lent out. So reserve ratio basically tell us how much is the bank keeping and how much is lending out. So basically this will make this side to be 100 and this side will also be 100. So when the bank gets a deposit, it doesn't really lend out everything. It keeps some in its reserve, and that reserve ratio is decided by the central bank. But this story doesn't end here, because when this loan goes into the economy, somebody uses it. And when he uses it, let's say if I decide I take this as a loan and I then buy, let's say, sneakers from this money, and that sneaker sort of shop owner then decides to put that money in his bank. Let's call this bank number 2. So bank number 2 gets this sort of deposit of deposit of 90, which then would mean another reserve would be created, because they will also keep 10% of 90, which is 9 in the bank, but they will also loan out 81. And this process is a recursive process, because then again this will be loaned out, will be another deposit, of which let's say 81 ka 10% would be 8.1. 8.1 would be minus would be 72.9, if I'm not mistaken. So 72.9 would be another deposit, and so on and so forth. So basically what is happening is that every time bank is lending, more deposits are created. So like first 100, then 90, then 81, then 72.9, then ... If you add all this up, we'll find out this is actually equal to 1000. And the reason why it's going to be 1000 is because of this formula, where we say this, that the money multiplier is equal to 1 over reserve ratio, where the reserve ratio is, for example, 10%. So 1 over 10% would make it 10. So what we say is that your money supply, total money supply would be from this initial deposit would be money supply equals to initial deposit times money multiplier, which would be initial deposit is 100 times money multiplier is 10. So total money supply would be 1000. In other words, total deposits that will be created for one single $100 deposit would be 10 times more, because a money multiplier is 10. So 10 times 100 would be total money supply, of which how much is the bank lending? Bank lending would be money supply, which is 1000 minus initial deposit. So bank has been able to create $900 worth of loans from a single deposit of 1000. And that's why what we find out is this, that this reserve ratio becomes a very important tool. Why? Because if I change the reserve ratio, suddenly lending can go up or down. And if lending goes up and down, money supply will go up and down. How? For example, if I say this, the reserve ratio is not 10%, reserve ratio is now 20%. That would mean money multiplier would be 1 over 20%, which means 5. Which means that money supply would be 5 times 100 or 500. Are you all with me? You increase the reserve ratio, money supply went down, because banks will be lending less, because they will be retaining or reserving more amount. So what we say is just that higher the reserve ratio, lower the bank lending, and therefore lower will be the money supply. So the one way the government through the central bank controls money supply is through what we call reserve ratio. When you change reserve ratio, you will see that the money supply will change. The second sort of thing which happens, which can change our money supply, is what we call open market operations. Basically, open market operation is what we call buying and selling of government securities. You know, when the government's selling securities, when the government sells securities, basically the securities will go to the economy. In return, they get the money. If they get the money and they don't spend that money, automatically money supply will go down. Make sense? When the government sells securities, money supply will fall. Because the securities will go to the economy, the money will come to the government through central bank, and that doesn't get spent, and therefore money supply will fall. On the other hand, if the government buys securities, this time around, the securities will come back to the government, the money will be given to the economy, and therefore money supply will go up. So when the government sells securities, money supply will fall. When the government buys security, money supply will go up. In the case of deficit financing, so this is not deficit financing, the first case that we just discussed, this is not deficit financing. In the case of deficit financing, when you owe people money, you are raising money because you have to spend that money as soon as you raise that because you owe people money. So you have a deficit where T minus G is less than 0. So government has done more spending than its revenue. They can reach out to two parties. One we call non-bank sector, which is your general public, anything which is not a bank. Bank by definition is someone who an entity which can take money, deposit money and then lend it out. So non-bank sector से ले सकते हैं या तो आप पैसा, you can finance your deficit through non-bank sector or through to the banking sector. Okay, when you go to the banking sector, this means you go into the commercial bank or the central bank. Now, if you go to the non-bank sector, what we actually say, if you go to the non-bank sector, money supply will be unchanged. Think of a scenario. Let's say person A bought the security. So that person A who bought the security, his deposit will go down by 100. Makes sense? The government got that money, 100 came to the government, but money supply went down in the economy because person A bought it. But this money then go back to the economy when the government spend that money. Remember, government has to spend this money because they have a deficit. So person B's deposit will go up. Some person A's deposit went down by 100, person B's deposit went up by 100, money supply remain unchanged. Because the government has to spend this money. Had this been not deficit financing, money supply would have gone down. But in this case, money supply did not go down because this is making the deposits unchanged. Okay? If I go to the banking sector, things will be different. Now let's say if you go to the commercial bank will be like, oh, you need $100? Okay, they will give you $100 from this loan portfolio. Remember this loan portfolio? They will give you, let's say 90 from this loan portfolio, which would mean because they don't have the money, they only have the deposits. The only deposit that the only way they could give you is this loan money. They could have given it to people. Now they're giving it to the government. The government uses this to buy the securities, which would mean automatically the government uses this. The government gets that $90. The government spends that $90, and then it goes to this bank 2, and then bank 3, and bank 4, and next money supply goes up. Which means that when you go to the commercial bank or the banking sector, money supply will go up as no deposits fall when the government security is bought, but deposits may rise when the government spends the money. So when they sell the deposit to the commercial bank uses the loan portfolio money, the money that they could have lent to anyone, and because of that, no deposit went down, but other deposits would go up as soon as the government spends that money. So in other words, when you go to the commercial bank or banking sector, money supply goes up, and that's why we sometimes say this, that this is just like printing new money, creating more money. So this is for us creating more money. So in an MCQ, they may ask you that the government has a deficit, they sell the securities to the general public. What happens to money supply? Answer would be it will remain unchanged. Government has a deficit, it goes to this commercial bank. What happens to money supply? Money supply will go up. Okay? So that's the second sort of factor. The third factor is what we call sometimes total currency flow. In this total currency flow, basically what we're looking at is basically your X minus M balance. So X minus M is greater than 0. This means you have a country's current account which is in a surplus. Surplus would mean that more goods are going out of the economy, but money is coming in. This money may come in, for example, in dollars. The dollars may get converted into rupees, and the exporter will be given that rupees. And therefore, money supply will go up. Reserves will also build up, but money supply will also go up. Similarly, if X minus M is less than 0, you have a deficit. Deficit would mean more goods are coming in than going out, but more money is going out. And that would mean my money supply will fall. So a surplus on the current account may lead to money supply to go up, while a deficit may lead to money supply to go down. So these are the three reasons we discuss as how the government can change or how money supplies change in an economy.